right. Hello, everyone, and welcome to another episode of the Daily Way Refuel. I'm glad that got a reaction. It makes me feel good. So yeah, we've got a great panel here for you guys today to talk about, I guess, the boogeyman in the room, which is institutional staking and what that means for the Ethereum network. Yeah, I mean, I guess personally I'm less bearish on it than others out there. I think that it's actually a healthy evolution of where we're kind of going as an ecosystem. But yeah, before I get into all of that, I just wanted to let these two introduce themselves and what they're kind of working on. So yeah, Ben and Hong, yeah, just introduce yourselves.
Yeah, hi, I'm Ben from BTCS. I'm the VP of Engineering there. BTCS is a publicly traded Ethereum NASDAQ company. We focus on Ethereum infrastructure, but we're also a digital asset treasury by second nature as well. So we accumulate Ethereum funds and deploy them into DeFi and staking.
Great to be here. I'm the CTO and co-founder of Bitwise. Bitwise is an asset manager that specializes in this asset class. And we manage about $10 billion worth of client assets in ETF-like products, generally regulated financial products. And we also have a staking division that stakes about $5 billion worth of ETH in a self-custodial manner. So that's not inside the kind of traditional investment vehicles, but just clients that hold ETH directly. So I think those are the two kind of ways, yeah, that we engage with this question of like institutional staking within our financial products, and also institutional staking offering to institutions that custody ETH themselves, but stake through us.
Mm-hmm. Yeah, so maybe the first thing I wanted to talk about was something that I think a lot of people have a misunderstanding about, and it's kind of what providers or what staking kind of setups the ETFs are going to use and the DATs are going to use, because Hill Dobby had a slide just before talking about if all of these ETFs stake with Coinbase, then Coinbase's staking share goes up massively, and that's really bad for the network. But I think a lot of these entities, DATs or ETFs, they actually aren't going to stake with Coinbase. They're going to be doing their own operation for a number of different reasons. And I know Hong Bitwise recently acquired a Testin, which is a staking operator that has been around for a while. And that just, I guess, like for me, sends a further signal out there that you know, the ETF issuers and the DATs are interested in running their own setup. So maybe you can talk a little bit about how Bitwise is going to be approaching this and what that kind of looks like in the context of the broader Ethereum staking ecosystem.
Yeah, absolutely. So Bitwise acquired a Testin last year. A Testin was a small focused team around ETH staking and has been staking since the genesis, and also is well known for the open source contributions around Vouch and Dirk. And they were experts and very much aligned with the ecosystem and network that we really loved, and brought them into the Bitwise fold last year. And yes, I think something worth noting is like Coinbase custody doesn't mean that necessarily if you're staking through assets custodied on Coinbase, that's going to Coinbase's validators. Mm-hmm. They have a number of validators on their platform, 4 or 5, let's say. A Testin is one of them. So our ETFs on the US side is custodied with Coinbase, but would be staked with a Testin. Mm-hmm. That is the case for BlackRock, Fidelity, or like the other large issuers as well. So I think it's worth considering the difference between custodied and then staked can be a different operator, even though it's from that type of setup. And yeah, I think the way that we thought about it is that staking is a much more active relationship with the protocol and the network than custody. Custody just involves custodying the private key, and it's much more of a passive role. But staking and participating in consensus is much more active, and that we wanted to be have a product where we engaged in that way, and that is a way that we can be different from the BlackRocks or Fidelities of the world. Mm-hmm. In some ways, you can think of Bitwise in the US ETF world. We have about a $500 million fund, and the total kind of assets in US ETH ETFs maybe 10, 15 billion or so. Mm-hmm. So we have, let's say, something like 5% market share. So we're kind of like like the independent solo staker of institutions, let's say. And I think that role is very valuable because we can push for practices that we think are both institutional and better for the network, and implement them in these regulated products and demonstrate to the world that it's possible to do it that way. And Hilda, we mentioned that we did that, for example, with Bitcoin ETFs, where we published the addresses and demonstrated that that's possible. You can do proof of reserves in these US regulated ETFs, and we also donate 10% of the profits of the ETFs on the ETH side and to the Protocol Guild and the PBS Foundation. So we're one of the main ways that we think about how we're different from just the traditional players is that we have traditional products, but we try to build them in a way that is that can be kind of further contribute to the network and the protocol, and that people that care about that buy our product. I mean, there can be a symbiotic kind of relationship there. So I think staking was one of the elements that we thought of as something that we can take on that could make our product better, and that we can also contribute back to the network as well.
Yeah. So I guess, Ben, shifting over to how the DATs view things, I think the DATs maybe have more flexibility than the ETFs do in order with what they can do within staking, but also what they can do outside of that. And I know BTCS has been doing Ethereum staking for a while now. One of the first, I think, big entities to kind of do it. So maybe you can talk a little bit about that and how maybe it differs from the ETF context.
Yeah, one thing that we say is that if you're a digital asset treasury on Ethereum and you're not doing active operations of your assets, you're worse than an ETF. Why would you buy a DAT that's not doing operations on chain? You should buy BlackRock, or not BlackRock. Sorry, not BlackRock. My boy. For a little slip right there. But yeah, we look at it from the point of view that we're really fighting for BIPs over other DATs, right? And if you're selling or giving away BIPs to a staking operator or node provider, you're not going to be competing on the same level as a digital asset treasury that's staking in-house or doing operations in-house. We see that as a huge competitive edge over other DATs. Obviously, other DATs are doing the exact same thing. I mean, once these DATs come online, they see the opportunity with LSTs to get staking almost immediately with very little operations. But they're giving away a portion of that to the middleman, right? But yeah, I think it's a huge competitive edge to have in-house operations, and obviously companies like SharpLink being so close with Consensus, and already Consensus having operations with that, it's very natural for them to get into there, where we see other companies like Bitminer taking a little slower and more conservative approach for that.
And I think that might be another thing that people kind of miss is that, as you said, it's about BIPs. It's about kind of generating the most amount of value that you can for what you're trying to do here. And Ethereum staking has become incredibly competitive, not just with the ETFs and the DATs, but also with all these other kind of protocols out there. And that's actually healthy for the network. For sure. So if we were to talk in the context of network health, which is what a lot of people tend to worry about, it's like these bigger stakers these bigger institutions coming on board and staking, people will obviously worry and say, oh, well, what if they get such a huge chunk and then they've got a vested interest in, going after the core development process and influencing that. So that's always a big concern here. But for me personally, and I've spoken to a bunch of people about this, I just think that the fact that we have this broad competition between the DATs, between the ETFs, between the existing kind of providers, and obviously the solo stakers, it's actually a really healthy ecosystem, and it's very hard for any of these entities to actually acquire a large percentage share. Even the greatest boogeyman, Lido, that we've all been talking about for years, their market share has gone down considerably as well. And in the same kind of time, they've actually become more decentralized, or they've at least moved towards a model where they can onboard even more operators. So on that kind of topic there, how do kind of you guys think about that? Do you think that there's a certain point where you think that your percentage of the network stake should be kind of capped at? You think, oh, maybe if we get to 5%, 10%, we shouldn't go beyond that? Because that was another discussion that also happened within the Ethereum ecosystem, is self-capping, which doesn't really make sense from an economics perspective. It's or from a capitalism perspective. But do you often think about that? And kind of how would you approach that if you were to get to that level?
It'd be a great problem to have.
Yeah, yeah, exactly. Like 5-10%. That's the thing. I think because there's so many providers, it has become very difficult to get there.
Yeah, you know what they say is Tom Lee's coming for your ETH, right? So hold on.
Yeah, exactly. Yeah.
So I think that the risks of so much or Ethereum being held by institutions in the U.S. is obviously censorship is the biggest one, right? Like I don't really think that there's a huge centralization risk of too much capital being held by a single entity, but all of that capital or all those validator operations like being run by institutions, you see OFAC compliance being a major concern, right? Which is a huge concern of ours as well. Like we've been working with teams like Shutter to help facilitate encrypted mempools into Ethereum so that we can get around that in the future, and hopefully that the protocol is able to get past that censorship resistance, or to get more censorship resistance to the institutions. But yeah, overall, in terms of self-capping, I don't think you can get any of these any public companies self-cap.
I think for things like censorship resistance, I think that's why proposals like Fossil are very important, because ultimately the network can't be censorship resistant over time if the way in which it maintains that is to rely on stake weight, the largest stake weights to agree to censor or not censor. That's a very fragile system in some ways. And so if a minority home stakers, solo stakers, or smaller participants, I mean, like in the US ETF world, I said that we're 5% market share. So if our 5% market share of the validators that we run with kind of our own principles that might be different from BlackRock or Fidelity can contribute to censorship resistance in a meaningful way. In the current world, it might not be, like our relay setting. Anyways, but I think that's why if we can solve it in a protocol and network way, like things like Fossil, where a small minority can contribute to a meaningful amount of censorship resistance, and that would be the kind of preferred protocol solution. Right. Another thing that I would just say on this note is that I think the way that Bitwise thinks about this question of institutional staking growth is, can we actually make the network better as an institutional staking provider and our stake weight growing? And so like an example of that is that we write our own multi-node validator client called Vouch. And what that allows you to do is that it allows you to run multiple consensus clients and have a stronger consensus rule internally within a validator about what blocks you would attest to and propose. And so, for example, the kind of super majority fork problem that we had on Plesky, if you want to avoid that type of problem yourself, and if a significant portion of the network had that type of policy, then that would make the chain itself much more improved in terms of addressing that type of supermajority fork risk. And so that is something that we write that software and maintain that, but also we run it in that way. And so we're increasing the stake weight that is considering the long tail of protocol risks that maybe a smaller player might not be thinking about, because you have to run all of the consensus beacon nodes rather than just one, and that is a kind of higher requirement. Another example is we write and maintain a threshold key signer called Dirk, which is essentially kind of sharding or kind of MPC, like multi-sig type thing for validator keys. And that requires you to run multiple machines, and we also make sure that they are in different server providers as well, so that you have much more resilience and security, and that increases the security and resilience of the network ultimately if more of the network is less resilient to kind of single validator key risk. And it's just a bigger operation. You need to maintain more server provider relationships. We run all of our machines in bare metal server providers, and so maintaining those providers and machines and like setup for failover and all those things requires more work. But if you're set up as a company to do that, and that's what you do, then you can get it done. Right. And so in that way, the larger amount of the stake weight of Ethereum can be more resilient to higher uptime and security. And so there's exciting aspects as well. I was talking about ETFs for a second before, and ETFs allowed us to do kind of profit donation to open source. ETFs allowed us to do kind of proof of reserves because, again, the pooled aspects of things allowed us to do something different. So I think that's how Bitwise thinks about it. Like institutions or kind of an institutional approach to things isn't necessarily de facto bad. There's actually opportunities for the institutional approach to actually improve the network because we're a different type of participant in the network. And of course, there's the risk that the large kind of economic agent or actor doesn't care about the network or the product properties of the protocol. But that also kind of motivates me to grow Bitwise because I want to make sure that a large economic player cares about the network and consensus and all these things.
Yeah, we see that a lot with DATs. They look for the lowest lift way possible to get yield exposure. And you're right, you have to be an active participant in the network, and there's a lot of these amazing tools out there, especially DVT. Obviously, we're going to be hearing from plenty of people about DVT. It's been around for a long time. I know the team at Obel and SSV are making huge strides in the resiliency for these teams as well.
Yeah, that might be something that a lot of people may not know as well. Like you mentioned Vouch. I know of Vouch because I'm a nerd and I followed a testnet for ages, but you know, Vouch is probably something people haven't heard of in the audience before, at least some people haven't heard of before. But as you mentioned, there's DVT as well, and there's other technologies that make staking or running validators or being a node operator safer, more efficient, more secure for these entities. And actually, like, there are ways that you can have these setups that you actually take your own kind of power away, like in terms of your control over your setup, so that it has to go through multiple kind of layers in order for something to kind of happen here.
Yeah, and just on that note, like, we talk about client diversity. Ethereum community puts in so much effort and to some extent takes a hit on coordination overhead and execution speed to maintain many clients, right? We have 6 consensus clients. So 6 teams writing and coordinating the same spec is much more, there's a hit on that. But there's a benefit to that. But in some ways, we're not maximizing that benefit because we say client diversity, but like you have 1,000 validators and 20% is running Prism and 10% is running like Lighthouse, et cetera. And, but from a fleet perspective, you might have diversity. From that validator perspective, if Lighthouse has a bug, that cohort of validators will go down, and that cohort of the network will go down. And unlike any other network that does not have client diversity, Ethereum actually has the ability to have none of the network go down when any one client has an issue and crashes, because you could actually have a multi-node validator client like Vouch where you're actually just running everything in parallel. And if one is just not up, then you can attest and propose blocks with the other consensus clients and beacon nodes that are up. And that's actually client diversity in the maximal way, not the like you have 10 machines and you run different consensus clients on each, but you actually run everything on all of them. And that is like, so I think like these types of it's not just prudent for the assets and is kind of part of the fiduciary responsibilities like issuers like us have, but I think there's ways in which it can concretely benefit the network's resilience.
Yeah, and I do find it funny, like you mentioned other networks. They're so weak compared to Ethereum if you look at it from like a validator kind of staking perspective. Like, we're talking about things here that are really tail risks a lot of the time. Like, they're edge cases, they're things that are worst case scenarios that we don't really expect to happen. And we've seen some pockets of stuff like over time, like obviously in the context of client diversity, we have seen some clients be super majorities, but then because we have client diversity, we could fix that. Then you have other networks out there, like even Bitcoin, that do not have this, and that it's quite risky. So I do find it a little bit funny how we put so much emphasis on this in the Ethereum community when we're actually in an amazing position already, and we've also future-proofed it, because you mentioned Fossil before. We're kind of future-proofing everything and putting in these changes, but it is very different to everything else out there. Like, I haven't seen this level of focus on this kind of stuff from any other ecosystem, which is really really cool. So I think Ethereum is well positioned there. But you mentioned DBT. I would like to just quickly hit on that. I think we're out of time soon. But DBT is another technology, distributed validator technology, that allows us to have more kind of like resilience in the network. So maybe you can touch on that. And is BTCS using it yet, or do you plan to kind of use it?
Yeah, we haven't announced it officially yet.
Okay.
But, it's coming into a public company. It was a big shift for me from private to public, so I can't share too much information.
Yep.
But we are actually transitioning to DBT right now. Actually, internally, I can't say the team.
Yep.
But we do see that as a huge benefit. The geographic diversity, there's huge incentives on there as well. Like we said, we're fighting for BIPs, but it opens you up to a lot of new possibilities on there. And there's also the ability to be client diverse through that as well.
Yeah.
So,
Yeah.
yeah, and likely we'll be moving to multiple DBT solutions, multiple client solutions. I know Vouch is a great tool. There's also another one. I forgot the name, but I see the guy. There we go. And so it's great to see that the market is actually focusing on the things that do matter. And those worst case scenarios do happen. We have seen issues where some clients are having adverse network effects through hard forks, and those teams are great at patching very quickly, but it's also a huge risk. But luckily, the network is so diverse.
Yeah. Yeah. Well, yeah. Exactly. It is so resilient, so diverse, and it's kind of crazy. Like, even if you think about, you mentioned the client teams themselves. Like, we even think about funding those people like long term. Like, what if the EF went away? Like, how do we fund these people? So just all of that kind of, I think, is extremely valuable, and it's why I don't worry about institutional staking being like this big thing that's going to like take over the network and everything's going to be bad. I think we've put in enough kind of guardrails and enough different kind of ways of staking and making things resilient that we're actually really well positioned for the future there.
Completely agreed.
Yeah, yeah. Unless you guys have anything left to say, I think that's time there. If you wanted to add anything, Hong or Ben?
Yeah, I think the part two I fully worry about if institutions start meddling in the kind of like L1 protocol roadmap type of thing.
Yeah, yeah.
So I think it's good for players like Bitwise to have a good distance from the client development, especially on the L1. And so that's why, for example, in our ETH ETF, when we think we should still be funding the development because our business depends on it, and also we have some economic ability to do so. So that's why we donate to the Protocol Guild rather than individual teams or individual people, because that's a more credible way for us to have almost like distance between the decisions, but still support the development. And yeah, and I guess we think a bit differently on the staking operational layer, because that is more so taking the protocol and running it in a way that is resilient and secure. And we have views on that, and we think that there's ways in which we can do a better institutional job about it without having the kind of distortions around the protocol direction.
Yeah, on the tone of what scares me most about institutions is how institutional, I guess, trust in Ethereum could be lost quickly by an institution losing access to their keys, losing access to their crypto, and doing things the wrong way. And so we do actually recommend teams if they aren't comfortable doing it in-house. We've talked to a lot of these newer dads across Ethereum, BSC, and other networks as well. We push them in the direction of other custodians.
Yep.
Because we want that. One goes down, it's bad for all of us.
Yep.
So that keeps me up at night.
Yeah. So. Fair enough. Okay. Well, yeah. I think questions.
We actually might have time for about one or two questions here. Okay, in the back row.
Sorry, not a question, but just for a piece of history, I think the client diversity really showed in the Shanghai DOS attacks.
Yes.
I think that was a big point of people remembering how hard that was to get through.
Yes.
Yeah. And also, I think in the proof of stake world, on the consensus layer side, we've had some issues there as well with participation drop-offs. Don't think we've lost finality, but we got close. So yeah, another point there.
Yeah, and also in the PBS lifecycle as well, some clients weren't fully signing the blob payloads, and we saw a huge loss on there. I used to work at Blockstrat, and I was part of the team that kind of caused the issue. But
yeah, okay.
There were actually some client teams that were able to work around that properly.
Yeah,
so,
awesome.
Yeah.
Hi. I was wondering if you had any thoughts on like liquid staking tokens and using those, or even like restaking would be even more risky. But yeah.
I have a lot of thoughts on liquid staking tokens. I've talked about it at length so much already. Liquid staking tokens have been at the forefront of innovation in the space lately. A lot of people are looking for clarity from FASB and the SEC specifically for holding liquid staking tokens. Personally, at BTCS, we don't touch liquid staking tokens because we've seen two different companies, specifically SBET and EthStaker, take opposing views that one of them will have to restate their financials because of it. And we don't want to be on the wrong side of that. It's a very, very bad thing for investor relations and trust in the market. Well, not liquid staking tokens. Liquid staking tokens are great, but the lack of guidance from the government right now has been a huge hindrance for us to get into that.
Let me ask maybe a follow-up to that question, which is, a couple of the liquid staking protocols like Lido, CSM, Rocket Pool, they use a distributed validator set, right?
Mm-hmm.
Maybe not DVT, but just home stakers, right, that participate in their network. Have either of you two considered using their node operator set to help diversify your operators?
We are a node operator on Rocket Pool. That was one of the first initiatives when I got to BTCS was to join one of the distributed networks as well as a node operator. But yeah.
I think it would depend on the product, but I think for ETFs, especially in the US side, there's more requirements around having direct relationships with service providers and understanding kind of their operations and liability and how to deal with those things that make it a little bit hard to interact with a kind of a pool of operators that we don't have those types of relationships with. So yeah, but that's not the gating factor of using LSTs inside US ETFs, for example. The gating factors are more so for the largest products that are kind of commodity ETFs. Those are single asset products, so it's hard to blend ETH and LSTs. And if you're creating a single LST ETF, then that has its own trickiness and issues. So there's some complexity there, but yeah.
Excellent. Well, please give our panelists and our panel members a round of applause.
Great. Thanks, everyone.